The prevailing narrative, the undercurrent shaping these moves, is undeniably the dawn of the Kevin Warsh era at the Federal Reserve. This leadership transition casts a long shadow, prompting a reassessment of monetary policy expectations and risk appetite across the board. We're observing modest but telling movements in equity futures, suggesting a cautious optimism, or perhaps simply a holding pattern, as market participants digest the implications of this significant change at the helm of the world's most influential central bank. Beyond the equity landscape, we're tracking a particularly active period in commodities and the digital asset space. Gold continues to find strong buying interest, signaling persistent geopolitical anxieties and perhaps a defensive stance against potential inflation. Crude oil and natural gas futures are both showing notable strength, driven by a confluence of supply concerns and winter demand pressures. And then there's the cryptocurrency market, which has seen some significant volatility, with Bitcoin experiencing a sharp correction that has reverberated through related corporate entities. This morning, we'll delve deep into the why behind these movements, exploring the interconnections that truly drive market dynamics in this evolving global environment. The financial world is a constant dialogue, and today, certain voices resonate louder than others. Foremost among them, of course, is the incoming Federal Reserve Chairman, Kevin Warsh. His appointment has immediately shifted the discourse from quantitative easing and dovish stances to a potential tightening bias, a renewed focus on inflation, and a more streamlined approach to monetary policy. The market is actively trying to decode his likely playbook, and this uncertainty is a powerful catalyst for the movements we are observing. On the corporate front, Michael Saylor, the face of MicroStrategy, continues to be a pivotal figure in the cryptocurrency narrative. His unwavering conviction in Bitcoin, despite recent market fluctuations, has both inspired and, for some critics, drawn scrutiny. The performance of MicroStrategy's shares is intrinsically linked to Bitcoin's fortunes, and as the digital asset space navigates a period of correction, his statements and actions carry amplified weight. We also hear from other titans. Jamie Dimon, ever the pragmatist, has weighed in on broader economic conditions and regulatory challenges, adding another layer to the complex picture. Christine Lagarde at the ECB, facing her own set of global strains, remains steadfast in her policy approach for now, highlighting the divergence in central bank strategies across continents. Meanwhile, Jensen Huang, the CEO of Nvidia, continues to shape the AI revolution narrative, asserting the transformative power of artificial intelligence while addressing its potential impact on established software paradigms. Each of these voices, in their respective domains, contributes to the intricate tapestry of market expectations and future trends. The bond market, often the truest barometer of economic expectations, is reflecting the uncertainty and shifting landscape following the Fed leadership change. We're observing a slight increase in the yield on the benchmark 10-year Treasury, a move that, while modest overnight, speaks volumes about the market's forward-looking perspective. This upward pressure on yields isn't just about inflation fears, it's a direct response to the anticipated policy shifts under Chairman Warsh. His reputation suggests a more hawkish inclination, potentially favoring higher interest rates sooner rather than later to combat persistent inflationary pressures. The market is pricing in this possibility, leading to a recalibration of bond valuations. Higher yields make government debt more attractive relative to other assets, but they also increase borrowing costs for businesses and consumers, a crucial factor for equity markets. The subtle rise in volatility, as indicated by the VIX, further underscores this environment of adjustment. The bond market is essentially trying to discern the new equilibrium point, balancing growth prospects against the specter of tighter monetary policy and the potential for a more aggressive approach to managing the money supply. This will be a critical space to watch as the new Fed era truly begins to unfold. The central bank landscape is undergoing a significant seismic shift with Kevin Warsh's appointment as the new Federal Reserve Chairman. His approach is anticipated to mark a distinct departure from previous administrations, with a likely emphasis on inflation control and a less interventionist stance in asset markets. The market is now grappling with the implications of a potentially more disciplined, perhaps even hawkish, Fed. This could mean a quicker pace of rate hikes, a reduction in the Fed's balance sheet, and a more stringent assessment of economic data. The timing of key U.S. economic data releases, specifically the updated CPI inflation and unemployment jobs reports, will be paramount. These reports, freshly scheduled after delays, will provide the first tangible inputs for Chairman Warsh's nascent policy framework. Any signs of persistent inflation or robust employment could embolden a more aggressive posture from the Fed, further solidifying expectations for tighter monetary conditions. In stark contrast, across the Atlantic, the European Central Bank, under Christine Lagarde, appears poised to hold rates steady. Despite global strains and choppy markets, the ECB's focus remains on navigating a more delicate recovery, suggesting a divergence in monetary policy trajectories between the US and Europe. Similarly, the Bank of England is also expected to maintain its current rate, balancing inflation concerns with the need to support economic growth in the UK. This creates an interesting dynamic, a potentially hawkish Fed against more dovish central banks elsewhere, which could have significant implications for currency markets and global capital flows. The Warsh Fed, even before its first policy meeting, is already dictating the global central bank conversation. The commodity complex is signaling a clear narrative of geopolitical tension and robust demand, driving significant overnight moves. Gold, the perennial safe haven asset, has seen a strong advance. This movement is not merely a reaction to a single headline, it's a reflection of broader market anxieties. Ray Dalio's recent warnings about a potential capital war and the weaponization of money resonate deeply here, as investors flock to tangible assets like gold to protect against currency debasement and geopolitical instability. The yellow metal's resilience underscores a lingering unease that prudent investors are looking to hedge. In the energy sector, crude oil futures have surged, largely on the back of renewed concerns over US-Iran negotiations. Any hint of instability or disruption in the Middle East, a critical global oil supplier, immediately sends ripples through the market. The fear premium is palpable, as traders price in the potential for supply constraints in an already tight market. Adding to the energy narrative, natural gas prices have leaped higher. This is a classic winter demand story, further amplified by the realization that winter's not done yet, as highlighted by natural gas intelligence. Colder temperatures across key consumption regions are fueling demand, putting upward pressure on prices. The confluence of geopolitical risk in oil and seasonal demand in gas illustrates a commodity market that is highly sensitive to both macro-level events and immediate climatic conditions, all contributing to a rising cost environment for energy. While the US market remains closed for physical trading, the implications of overnight futures movements and recent news continue to shape sector expectations. Looking at the technology giants, we see a divergence in sentiment. Apple, for instance, has shown some notable strength, potentially reacting to optimistic forward-looking projections or a perceived resilience in consumer electronics demand. This strength often indicates a broader confidence in the consumer's purchasing power, even amidst macroeconomic headwinds. On the other hand, several other prominent technology players, including Nvidia, Tesla, Amazon, Meta, and Google, have experienced some negative pressure overnight. For Nvidia, despite its foundational role in the AI revolution, some of this movement could be a natural consolidation after an unprecedented run, perhaps also influenced by comments from CEO Jensen Huang about the illogical nature of assuming AI will entirely replace existing software tools, a nuance the market may be digesting. Tesla's volatility is almost a given, often tied to broader risk sentiment and specific company news, which in this case might be related to Elon Musk's ongoing legal challenges. The corrections seen in Amazon, Meta, and Google could reflect a broader re-evaluation of growth expectations in the face of potentially higher interest rates under the new Fed regime, which makes future earnings less valuable in present terms. The market is clearly distinguishing between companies, rewarding perceived stability or immediate growth catalysts, while applying pressure to those whose valuations might be stretched in a higher rate environment. The overriding theme here is the scrutiny of growth stocks, particularly those with long-duration cash flows, as the cost of capital potentially rises. The cryptocurrency market is experiencing a significant test of nerves, particularly Bitcoin, which has seen its recent gains challenged, struggling to hold above the critical 72,000 psychological level. This correction has cascaded across the digital asset ecosystem, with Ethereum also seeing considerable pressure. The narrative surrounding Bitcoin's dip is complex. While market cycles are inherent to crypto, some critics are pointing fingers at corporate whale activity, specifically questioning Michael Saylor's MicroStrategy. The perception of slowing or changing purchasing patterns from such a prominent corporate buyer, particularly one whose entire corporate strategy is intrinsically tied to Bitcoin, can create a ripple effect of uncertainty. MicroStrategy's shares have felt the brunt of this, experiencing a notable decline as its fortunes are so tightly coupled to the cryptocurrency's performance. However, not everyone is retreating. Cathie Wood's ARK Invest, for example, is reportedly doubling down on certain crypto-related investments, indicating a contrarian stance and a belief in the long-term potential of the sector despite short-term volatility. This divergence in strategy highlights the ongoing debate within the investment community regarding the true valuation and future trajectory of digital assets. For many, this correction presents an opportunity, while for others, it's a stark reminder of the inherent risks. The market is very much at a crossroads, where conviction is being tested. As we look towards the eventual opening of the US market, the landscape is already defined by the themes we've discussed. The dominant narrative will continue to be the anticipation surrounding the Kevin Warsh Fed. Investors will be dissecting every comment, every nuance, attempting to divine the true direction of monetary policy. Crucially, the market will be keenly awaiting the official release dates for January's CPI inflation and unemployment jobs reports. These are not merely data points, they are potential catalysts that could either confirm market suspicions about inflationary pressures or offer a reprieve, shaping the Fed's initial moves. Any surprises in these reports, once released, will undoubtedly trigger significant movements across equities, bonds, and currencies. Beyond macroeconomics, corporate earnings will continue to draw attention. While specific reports are not due immediately, the overhang of recent earnings and forward guidance will influence sector performance. Companies like Amazon, for instance, will have their Q4 reports closely scrutinized for insights into consumer spending and e-commerce trends, especially in a potentially higher rate environment. The ongoing dialogue around AI, as championed by figures like Jensen Huang, will also continue to direct capital flows within the technology sector. Expect a day of careful positioning and strategic adjustments as participants prepare for what promises to be a pivotal period under the new Federal Reserve leadership. As we close out this morning's analysis, it's clear we are standing at an inflection point. The transition of power at the Federal Reserve to Kevin Warsh marks a significant shift, signaling a potential return to a more orthodox approach to monetary policy, centered on inflation control. This fundamental change is the lens through which all other market movements, from the cautious advances in equity futures to the surges in commodities and the turbulence in crypto, must be viewed. The intertwining narratives of Fed policy, geopolitical risk, and technological transformation are creating a complex, yet compelling, market environment. Gold's strength whispers of underlying anxieties, oil and gas prices reflect tangible supply and demand dynamics, and the volatility in digital assets reminds us of the constant interplay between innovation and speculation. Michael Saylor's steadfastness and Cathie Wood's conviction in crypto, despite the sharp correction, underscore the deeply divided opinions on where value truly resides in this new financial paradigm. The week ahead will be about navigating this new terrain. Investors are recalibrating their portfolios, attempting to position themselves for a landscape potentially characterized by higher interest rates and a more vigilant Fed. My advice remains consistent: focus on the why. Understand the forces driving these movements, analyze the implications of these changes, and maintain a disciplined approach. The markets are always telling a story, and today, that story is one of profound transformation. Stay alert, stay informed, and always remain strategic.